our discussion. So topic 13, folks, is changes in ownership. And just a quick reminder of how accounting for investment works. Remember, if the investor does not have significant influence, then investments in other companies' shares are recorded either using the fair value profit or loss or fair value other comprehensive income, but that's an election that the investor has to make. Once significant influence is obtained, and that happens when typically when you own between 20% and 50% of the outstanding common shares of the other company, but there can be other indicators of significant influence as well over and above the percentage ownership, such as the representation on the board, ability to influence key decisions, exchange of managerial personnel, significant volume of intercompany transactions, and so on. So if significant influence exists, then the investor has to use the equity method to account for its investment. And if the investor obtains control, then basically a parent subsidiary relationship is established. If this is a purchase of common shares, then there is a parent subsidiary relationship, and the parent company must consolidate the financial information of the subsidiary into its own financial information. When we talk about changes in ownership, one aspect of that could be the acquisition or loss of significant influence by the investor. So recall I mentioned, the three stages. If the investor obtains significant influence from having no significant influence earlier, well, in that case, when significant influence is obtained, any shares that the investor may have owned earlier in the associate have to be revalued, remeasured to fair value, and any change is to be booked in profit or loss. We actually talked about this when we covered topic 4, investments in associates. And you folks probably even did a question on your midterm. Maybe not, maybe I'm forgetting, but we did an example in class for sure, where I showed how the investor did not have significant influence, later obtained significant influence, and the earlier existing shares are remeasured to fair value on the date of obtaining significant influence, and that resulting gain or loss is booked through profit or loss, i.e. net income. The obtaining of significant influence will trigger a change in accounting method from fair value profit or loss to the equity method. And that would mean an acquisition differential and goodwill are calculated. And later on, as the investor continues to buy more shares and keeps increasing its ownership, but continues to be in a situation of significant influence, each additional purchase or sale would trigger a separate calculation of acquisition differential and goodwill. If, for whatever reason, significant influence is lost, then any shares that the investor may still own afterwards have to be remeasured to fair value, and any resulting gain or loss has to be booked through profit or loss. The method of accounting needs to change from the equity method to fair value profit or loss. And similar set of things happen when you have obtaining of control from significant influence. So when control is acquired, any shares that the parent may have owned earlier have to be remeasured. Gain or loss is booked through P&L. The accounting method changes from the equity method to consolidation, and a brand new acquisition differential and goodwill has to be calculated. If, on the other hand, the parent company loses control, then any shares that it may continue to own after the loss of control have to be remeasured, and any resulting gain or loss goes through profit or loss. The accounting method will change from control, the consolidation, to the equity method if significant influence is still retained, or fair value profit or loss if it becomes a passive investment. So you may have seen the news about the Synovus buying Husky. So there was an announcement made that Husky is being purchased by Synovus. So Husky, the current largest shareholder of Husky is a Hong Kong-based billionaire, Li Ka-shing. His company owns Husky. After the fact, Li Ka-shing will own still a significant chunk of the combined entity. It will be operated under Synovus. So as for purposes of business combination, identifying the acquirer, Synovus will be the acquirer, but Li Ka-shing's company uh, will have a substantial enough stake so that they may be still able to exercise significant influence if they choose to. So what will happen is that Li Ka-shing's group will then have to account for their investment using the equity method. Now, if they choose to cede significant influence, then they can consider the investment as a fair value profit or loss. Your textbook talks about block acquisitions as well. So what happens there is that the parent company can obtain control over the subsidiary through a series of purchases, starting with a very small purchase, gradually building up significant influence and ultimately control. So, like we just talked, the accounting methods would need to reflect the nature of the investment at each stage. The small purchase will likely have been accounted for as fair value profit or loss. When we obtain significant influence, we move to the equity method. Then we get control, we'll have to start consolidation. Every time there is a change in the accounting method, the bottom line to keep in mind is each time the accounting method changes, it is applied prospectively. So you don't make any retrospective adjustment. It's applied on a go forward basis. And the investment, the investment balance before the change in the accounting method is revalued to fair value with the resulting gain or loss recorded in net income, the P&L. Our discussion in topic 13 is going to be focused more on changes in the parent company's ownership, where the parent company retains control. So we're not talking about a loss of control scenario or a new acquisition of control scenario. We're talking about a change in the percentage ownership of the parent company. So there's four ways in which that can happen. Either the parent can increase its percentage ownership by buying extra shares of the subsidiary in the open market, which would mean essentially buying those shares from the other shareholders. So parents' percentage ownership goes up, non-controlling interests percentage ownership falls as a result. Or there can be a decrease in the parent's ownership if the parent was to sell some of its shares in the subsidiary. So whoever the parent sells the shares to, they will become part of non-controlling interest. So for example, if the parent company originally owned 80% of the common shares, if the parent company is to buy an additional 10%, the parent's percentage ownership goes up from 80% to 90%. Non-controlling interest percentage ownership will fall from 20% to 10%. If the parent were to sell 10% of the shares, then the parent's percentage ownership will decline from 80% to 70%, and non-controlling interests will go up from 20 to 30. Now, there's another way in which that can happen. The change in parents' ownership can take place, and that is if the subsidiary company either buys back shares from the public, thereby concentrating the percentage ownership of the parent, or issues new shares to the public, and that ends up diluting the percentage ownership of the parent company. These transactions are treated as transactions with shareholders, and we use the subsidiary's adjusted net book value to compute the value of the transaction. Any resulting gain or loss from the point of view of the parent company is recorded in retained earnings or in contributed surplus as the situation might warrant. And no recalculation of acquisition differential or goodwill is needed. All right. So the remaining 4 slides, I'll just let you folks watch from the video. I'm going to dive into an example. Well, 2 examples basically, but one after the other. So example 13.1 and 13.2. So 13.1 is the base question that I'll begin with. On Jan 1st, 2001, Price Company acquired 70% of Slice Company for $1.4 million. On the acquisition date, the fair value of net assets was equal to their net book values, without the exception of a previously unrecorded patent that had a fair value of 200,000 and a 10-year life. So given that the acquisition cost is 1.4 million, we get an implied value of 100% of Slice as being 1.4 million divided by 70%, $2 million. And on the date of acquisition, so that was Jan 1st, 2001, Slice Company had $1 million in common shares, and the retained earnings on January 1st, 2001, so the beginning retained earnings for 2001 will be the balance on Jan 1st, 650,000. So total net book value of Slice on Jan 1st, 2001 was $1 million common shares, $650,000, the beginning retained earnings balance. So total net book value of Slice on the date of acquisition was 1,650,000. You subtract that from the implied value of 100%, we get 350,000 for acquisition differential. This one, we're told, is allocated first to a patent, an unrecorded patent, worth 200,000. So out of 350,000, if you allocate $200,000 to the patent, you get goodwill for the remainder amount, $150,000. Okay. Is making sense so far? Hello from the other side. Yep, okay. The goodwill sale got mixed up. That's me. What did I do? Oh, just undo it. Yeah. Okay. So then what happened? On July 1st, 2002, Price Company sold a capital asset to Slice for 192,000. The capital asset had a net book value of 167, remaining life of 5 years. In 2003, Slice Company sold merchandise inventory to Price for this much. Original cost was 100,000. End of the year, end of December 31st, 2003. That's a typo. It should be December 31st, 2003. 30% of the inventory remained on hand in the ending inventory. Both companies have a 40% tax rate, yada, yada. So basically what ends up happening is on December 31st, 2003, Price Company acquired an extra 10% of Slice or $340,000. And what we're asked to do is calculate the balance of the investment in Slice Company under the equity method for that date, and also make the journal entry if needed to record the transaction in the books of Price Company. So in the slide I showed, I was saying this transaction, to measure this transaction, we need to calculate the adjusted book value of Slice Company. We'll base it off on the adjusted book value for Slice Company on December 31st, 2003. All right. Now, in order to get there, we have to do a little bit of preliminary calculation. So the patent on Jan 1st, 2001 had a 10-year useful life, right? So beginning with the fair value differences. Now, goodwill, there's no word about there being any goodwill impairment, but the patent, 200,000 divided by 10 each year, $20,000 would get amortized. And so from Jan 1st, 2001 to the end of 2002, we would have $40,000 worth of amortization. For the year 2003, we would have had another 20,000, leaving us with an unamortized balance for the patent, 140,000. Goodwill was not impaired at all over the years, so goodwill will remain untouched. And then with regards to intercompany profits, there was a downstream sale of the capital asset, the equipment. So Price sold a piece of equipment to Slice for 192,000, and that sale happened on July 1st, 2002. The capital asset had a net book value of $167,000 at that time. So the intercompany profit on the equipment is 192,000 minus the 167, $25,000. Now that amount of 25,000 would get realized over time, over 5 years. So from July 1st, 2002 up to the end of 2002, so 1/5 of 25,000, is $5,000 for the full year. From July 1st to December 31st is 6 months, half a year. Okay, so half of 5,000, the amount realized up to the end of 2002 is 2,500. So we would had a remaining unrealized balance at the end of 2002, $22,500. For the year 2003, 1/5 of 25,000 would have gotten realized. So that's $5,000, leaving us with an unrealized balance of 17.5. And the tax rates for the two companies is 40%. So you can calculate the tax and after-tax amounts. Hopefully this is fairly okay by now. Step 6 from consolidation. And then there is an upstream inventory profit, 2003, Slice sold merchandise to Price for 160,000. The merchandise had originally cost 100,000. So the difference is $60,000. This $60,000 of the profit is considered unrealized until the inventory is sold to outside parties. So on December 31st, 2003, okay, that's my bane. I just keep making these stupid typos. It should be 2003, folks, okay? 2003. On December 31st, 2003, 30% of the inventory remained. So 30% of the $60,000 profit remains unrealized in the ending inventory for the year 2003. 30% of 60,000 is $18,000. Tax after tax gives us $10,800 after taxes. Now, why did we do this calculation? Because when we do the calculation for the adjusted net book value, we will need the unamortized acquisition differential, and we would need the upstream inventory profit that has to be adjusted for. So the adjusted book value calculation is done similar to step 9. If you remember your consolidation steps, and I don't think there's been enough time for us to forget those. Step 9 is the calculation of non-controlling interest. And what we do there is we begin with the net book value of Slice, so the subsidiary, on December 31st, 2003. December 31st, 2003, Slice has common shares, $1 million, and its ending retained earnings is 1,050,000, or basically the shareholders' equity, $2,050,000. $1 million in common shares, $1,050,000 in retained earnings gives us a total of $2,050,000. That $2,050,000 needs to be adjusted for the unrealized upstream ending inventory profit. So you want to subtract the upstream ending inventory profit, 10,800, and add the unamortized acquisition differential, and that's our $290,000. Remember, acquisition differential includes both the fair value differences and goodwill. So adding it all up, we get adjusted net book value of Slice, working out to be 2,329,200. This is the dollar amount we will use to calculate if Price Company had any kind of gain or a loss when they acquired an extra 10% of Slice Company, paying $340,000. So if you think about the journal entry, if Price Company bought extra shares, then they must have paid cash, 340,000 must have been cash going out. So you'll credit cash 340,000. And if they bought an additional stake in Slice Company, then it makes sense that they should debit investment in Slice. Now, normally what would we do? Normally we would credit cash for the 340,000, debit the investment, 340,000. Here, though, we don't, okay? Because Price Company already has control over Slice. So Price is already the parent company of Slice. Because of that fact, because Price already has control over Slice Company, we have to measure the value of this investment, this additional chunk that we bought, that Price is buying. We have to base it on this value, the adjusted net book value of Slice on December 31st, 2003, which is $2,329,200. For what percentage of Slice? This 2,329,200 is for all of the Slice Company, right? The entire subsidiary is valued at this much. So if Price has purchased 10%, then 10% of 2,329,200 is what we are going to debit the investment account for. So 10% of 2,329,200 gives you 232,920. So they bought 10% of the investment. The investment in Slice, the portion that they bought, is valued at 10% of the adjusted net book value, or 232,920. Of course, this means our journal entry is not balanced. We are missing a debit of 107,080. Now, this missing debit of 107,080, yeah, sure. So Joseph, how did we get the net book value of Slice? So right here is the financial information about Slice. Slice's shareholders' equity at the end of 2003 is 2,050,000. And what that is made up of is $1 million in common shares and $1,050,000 ending retained earnings. Okay, so as I was saying, we are missing a debit 107080. Now, this debit of 107080, you might be tempted to debit goodwill. Don't do that because we're not recalculating any acquisition differential. So there would be no goodwill. And anyways, goodwill is actually recorded as the journal entry, recorded as an account if there had been a purchase of net assets. That's not happening. You're buying shares. Okay, so don't debit goodwill. So another way of thinking about it is Price has purchased an investment which is valued at 232,920 and it has overpaid. So another way of thinking about it is Price has overpaid, so that means it has basically incurred a loss, right? A loss. So because these kinds of transactions are recorded as if they are transactions with shareholders, you will remember from your second intermediate accounting course, when a company buys back shares and pays more for those shares than the average book value. Probably remember this, when a company buys back shares, it's supposed to debit common shares, credit cash. You'll credit cash for the actual price paid. You'll debit the common shares using the average book value of the shares being bought. And if the company is overpaid, the difference is not recorded as a loss on reacquisition. It's recorded by debiting retained earnings, right? When a company buys back its shares, any loss is debited to retained earnings. Any gain is recorded through contributed surplus. Does that ring a bell? This was from Accounting 350, the second intermediate course. Shareholders equity chapter. Yeah. So this, the treatment here will be similar. So if you have the debit difference, then that debit difference will go through retained earnings. So our friend Price is going to debit retained earnings for the extra cost of buying those shares. All right, so that's the journal entry. Now, they did ask us to calculate the investment account balance. So how do we do that, the investment account? Well, if you look at the adjusted net book value of Slice, it is before the share purchase, the adjusted net book value was 2,329,200. And Price owned 70%, right? Price owned 70% of that 2,329,000. So 70% of 2,329,000 gives us 1,630,440. Now this 1,630,440 does not include the adjustment for the downstream unrealized equipment gain. So as of December 31st, 2003, there is a downstream unrealized equipment gain, which, remember, the parent has to adjust any kind of downstream profit has to be eliminated or adjusted for 100%, right? So Price Company needs to subtract $10,500, the after-tax amount of the unrealized equipment gain, from its share of the 70% share of Slice's net book value. So if you do that, you get investment in Slice before the additional shares were purchased. So this would have been the value, 1,619,940 will have been the value of the investment account under the equity method before the extra shares were bought. Now, they did buy extra shares, and the amount that is recorded is 232,920. So the additional 10% shares purchased, 232,920, we add to the 1,619,000, we get investment in slice after the share purchase, 1,852,860. So the amount that will be reported on the balance sheet will of course be after the 10% additional purchase. That amount will be 1,852,860. And basically, what is it made up of? It's made up of prices shared. We could have directly done 80%, right? I just showed you what the amount was before the share purchase. You didn't have to do this. You could have just directly put 80% to the 2,329,000. So if I put 80% here, that would give me 1,863. Take out the 10,500 and you would get the investment in slice. But if you wanted to do it in steps, then before the share purchase, price owned 70%. After the share purchase, price owns this much. This is worth like 80% of slice company. And if you think about non-controlling interest, because I mentioned NCI moves in tandem, when Price Company owned 70% of the shares, NCI would have owned 30%. 30% of the 2,329,000 would have given us 698,760. NCI would not have had to be adjusted for the downstream profit. So amount reported for NCI would have been 698,760. Like just think about what you would have done here. Once you got the adjusted net book value in step 9, the last line is NCI's share. And NCI's share would have been 30%. 30% of the 2,329,000 non-controlling interest would have been 698,760. Look at the total. So 1,619,940 plus the 698,760, you get a total of 2,318,700. What happens after the fact? If the 10% extra shares are purchased by price, this value 232,920 is transferred out from NCI, right? NCI will be reduced by that amount of, 232,920. So non-controlling interest after the 10% purchase by price, non-controlling interest will now become 698,760 minus the 232, 465,840. And if you add these two up, you get the same total as before, 2,318,700. Okay, so as I was saying, as the parent's ownership goes up, non-controlling interest ownership will fall. Okay, makes sense? Or any queries? Okay, let's look at the converse situation, and maybe we'll help solidify the understanding. What if instead of buying shares, Price had sold shares? So Price Company sold 8,000 shares of Slice for 280,000. So what happens in this case? Well, the investment should go down. So you'll credit the investment and debit cash. Well, how much would you debit cash for? 8,000 shares were sold for 280,000. So debit cash, 280,000. Now, how much do I credit the investment account for? Well, for that, I have to base my math on this number, the adjusted net book value, 2,329,200. 2,329,200 is the net book value of Slice, which has a total number of 100,000 shares outstanding. 100,000 shares is 2,329,200. 8,000 shares. Well, 8,000 out of 100,000. What percentage did price sell? 8%. So if you calculate 8% of the 2,329,000, you will get 186,336. So debit cash 280,000, credit the investment in Slice, 8% of 2,329,200, 186,336. And now we're looking at a credit difference of 93,664. And if you ask yourself, what do I credit here? It is along the lines of a gain on sale. But again, these transactions are considered transactions with shareholders. So we are not supposed to record gain. So as Feroz says, we want to credit contributed surplus. So credit contributed surplus. Now, in some of your textbook examples, the textbook authors have just used retained earnings. That is allowed under ASPE, okay? So ASPE permits companies to just credit their retained earnings. So that's not wrong. Don't get too overly upset. But ideally, we should be crediting contributed surplus. All right? Now, if we calculate the investment in Slice, well, before the shares were sold, the investment in Slice was 1,630,440. 70% is what Price Company owned. And there was an adjustment for the downstream equipment gain, 10,500. So before the shares were sold, the investment was worth 1,619,000. I'm just trying to show you that thus far, nothing would have changed. The investment in Slice before the shares were sold would have been worth this much. After the 8% shares are sold, we would reduce the investment in Slice by 186,336. So lower the investment account by the book value sold. And so after the shares are sold by the parent company Price, the investment account will be worth 1,433,604. And where does that 186 go? Well, it goes to non-controlling interest. NCI was 698,760. After Price Company sold the shares, this much value moves over to NCI. And so non-controlling interest will, after the fact, be equal to 885,096. The total of the investment account and NCI is still constant at 2,318,700. It was 2,318,700, remained 2,318,700 after the share purchase by Price, remains 2,318,700 after the share sale by Price. So that is an important little thing to keep in mind, that whatever happens, this exchange of value basically occurs between the parent company and non-controlling interest. So why don't we use 1.4 million minus the 186? So the investment account was 1.4 million on January 1st, 2001. But remember, since that time, the investment account under the equity method, right, calculate the balance under the equity method. So under the equity method, the investment account will have increased with the equity method income, decreased with the dividends, and also will have been adjusted for the intercompany profits and all that, right? So the original cost of the investment was 1.4 million, but when we're talking about December 31st, 2003, the investment is not worth 1.4. So that investment account has since then moved. For that, you'll have to keep track of what happened over the years. Each year, you will, so, so if you kind of do a continuity schedule, so investment in Slice, we would have begun Jan 1st, year one, we would have started with 1.4 million. Now, it would have gone up with net income, share of income. Now, share of net income for year one, net income for Slice for year one was 150,000. So 150,000 times the 70%, it would have gone down by dividends, right? So the dividends would have been 50,000 was the total. So 70% of 50,000. And then our share of the amortization of the patent would have reduced the investment account. So 20,000 times 70%. And so at the end of year one, the investment account's balance will be December 31st, year one, the balance will be 1,456,000, right? So exactly. So the 1.4 million, even though it would have been the cost. So when the equity method is used, when there's any kind of changes, we have to apply the equity method, not the cost. So even for internal record keeping, they may have, so for internal record keeping, really, if 1.4 million was 70% and they sold 8%, they would have then calculated 1.4 over 70 times 8 and calculated that amount. But that would be from a consolidation perspective, that would be incorrect. Okay. So I think Ife's figured it out, but what about the others? Are you guys okay with why we didn't use 1.4 mil? Yeah. Okay. All right. So 13.2 is a continuation of the facts that we just covered. Same question essentially. But here, what's happening is that on December 31st, year three, Slice issued an extra 20,000 shares to the public for $600,000. And the requirements are basically the same, right? Record any journal entry needed, calculate the balance in the investment account. This is an interesting little piece. The adjusted book value for Slice, our starting point is this number, 2,329,200. So before it issued any extra shares, the adjusted book value for Slice is 2,329,200. Now, if Slice Company issues an extra 20,000 shares for $600,000, think about the journal entry, debit cash, credit common shares. What happens as a result is cash goes up and common shares go up. When common shares go up, the net book value of Slice should go up. So it won't stay 2,329,000. With the additional share issued, the net book value will go up by 600,000 to become 2,929,200. Now, our friend Price didn't buy any of these 20,000 shares. Price had purchased 70% of Slice Company on Jan 1st, 2001. The total number of shares for Slice at that time was 100,000 shares. 70% of 100,000. Price Company owns 70,000 shares. On December 31st, 2003, when Slice Company issues an extra 20,000 shares, the total number of shares becomes 100,000 plus 20,000, 120,000. Out of the 120,000, Price Company owns how many shares? 70,000. So is the percentage still 70%? 70,000 shares out of 100,000 was 70%. But 70,000 shares out of 120,000 is not, right? So the percentage share after the additional shares issued by Slice Company, Price's portion is 70,000 out of 120,000. I would say use fractions. It's easier. It's 58.33333%. But I would suggest that you use fractions. Keep it at 7/12 or 70 over 120. And if you multiply this 2,929,000 by the new share, the investment account is now worth 1,708,700. Before issuance of shares, our friend Price had owned 70% of 2,329,000, right? 70% of 2,329,000 had been worth 1,630,440. Just this guy, right? It had owned 1,630,000. But now after the fact, Price's ownership is actually worth more. So that's an interesting little piece. Earlier, Price Company owned 70% of Slice, but its 70% ownership was valued or worth 1,630,440. After the share issuance by Slice, even with a smaller percentage ownership, the actual value of that ownership is higher. It's more. The investment is worth more. And some of you will probably be able to relate to this, especially if you folks like pizza. You know, even if you get a thinner slice of a bigger pizza, you might end up getting more pizza. Does that make sense? So with an additional, it is possible. Hugo's saying if Slice Company just went ahead and issued some more, like another 20,001 shares, then our friend Price will be owning less than 50%. So it is possible that they could end up control, but the thing is, if those other shares are widely dispersed, then control can still exist with fewer than 50% if the rest of the shares are owned by just a vast number of shareholders. Because Price Company could still own like 45% and still be the big poobah if the others can't gang up, right? If the others can't get together, then you can still have control. So it's not necessarily that will happen, but it's possible. So what I was trying to get at is even with a smaller slice, because the pie got bigger, right? Because Slice Company is worth a heck of a lot more after issuing the new shares, the smaller percentage ownership for Price Company ends up being worth more now than their larger percentage ownership, 70% ownership, had been before the extra shares issued by Price. That's typically how, venture capitalist companies make their money. They will buy a chunk of a startup at a fairly low price. Once the startup goes public and if it's got good prospects, the venture capitalists, even though the percentage ownership for the venture capitalists and even the founders, gets diluted because of the tremendously high valuation when the company goes public, they end up making a lot of money, right? So think about Mark Zuckerberg with Facebook, think about all the other people that came afterwards. Um, you know, that is typically the model. So sometimes, so the subsidiary, of course, could not have issued these extra shares without the blessings from Price, right? Price controls Slice. So these extra shares just could not have been issued without Price's go ahead, right? So why would Slice Company issue new shares? Maybe they needed some infusion of additional capital and Price did not want to inject that capital at that time. So they would have figured maybe, it's worthwhile to do a seasoned equity offering. And that's what they did. Now, bottom line here, if the investment account balance has gone up, does that represent a gain or a loss? I know we won't record it as a gain or a loss, but in common parlance, does this mean a gain for Price or would this mean a loss? If Price's investment value goes up, is that a gain or is it a loss? It's a gain, right? So the amount of the so-called gain from non-participation is 78,260. Now I put the gain in quotation marks because it's not going to be recorded as a gain, but rather as a credit to contributed surplus. So the investment account will be written up and you'll credit contributed surplus. Now, the question had asked us for calculating the balance in the investment in Slice Company under the equity method. We've still not answered the question yet. The answer to the question will be, okay, Price owns 7/12 or 58.333%, and that is worth 1,708,700, which is all fine and dandy, but that does not include the adjustment for the unrealized downstream equipment gain. Remember to make that adjustment. So as far as the investment account is concerned, you will have to adjust for the unrealized downstream profit. So calculate Price's ownership in Slice, but then make sure to remember to adjust for the downstream profits. Take out the downstream profit and you get the amount that will be reported on the balance sheet, the separate company balance sheet for Price Company, if it reports its investment under the equity method. Make sense? Yeah, that's dollars. Oh, okay. Took me a while to get that. All right, so if you folks got this, then it should be an easy enough move to the next part. Assume instead that Slice Company bought back and retired. So in Canada, federally, companies have to retire reacquired shares. There are some jurisdictions that actually allow them to keep treasury shares. So if you got a question on the exam and it didn't say retired, just assume that the shares that are bought back are retired. All right, because that's the federal requirement. So Slice Company bought back and retired 10,000 shares from the public for $320,000. Well, what happens as a result? So, in a manner similar to how we calculated part A, we'll start with the adjusted book value of Slice before the share buyback. That number, 2,329,000, is sacrosanct, right? We gotta so on an actual exam, you're not likely going to get all these different parts, right? So it could be just one of the parts. So you still have to make your way through. Maybe if you're comfortable, you don't need to necessarily do all of these detailed calculations. You can maybe save some time, but you still have to make sure that you have all the information you need to be able to calculate the adjusted net book value. Okay, because your transaction uh, is going to be valued at on the basis of this adjusted net book value number. So this calculation is common to all of these parts that I'm showing you. These parts are standalone questions almost on their own right, but you'd have to do these steps. You'd have to or figure out a way to know the amounts, the relevant amounts, in order to complete the question. Okay, so here, before the share buyback, the net book value was 2,329,000. Now, if the Slice Company buys back the shares, it's going to be paying out cash. And when it retires the shares, the common shares value will go down, right? So the share buyback is going to reduce the book value of our friend Slice. As a separate company, I know they would retire those shares at the average book value. And if they paid more than the average book value, they will reduce their retained earnings. Bottom line is the net book value will go down, right? The net book value will go down for Slice Company. So what happens as a result is that after the share buyback, the adjusted net book value becomes $2,009,200. This amount is the reduced value of Slice Company. And with how many shares outstanding now? Well, before they did the share buyback, they had 100,000 shares outstanding. When they bought back 10,000 shares, the number of shares outstanding will become 90,000. Price still owns 70,000, right? So Price Company still owns 70,000. But if you calculate 70,000 as a fraction of 90,000, it's more than 70% now, right? 70 out of 90 is 77.777%. So again, I recommend that you stick to fractions. So the fractional ownership basically is 7/9, 70 out of 90,000. So if you multiply the $2,009,200 by 7/9, you get a nice little number, 1,562,711. Before the share buyback, though, Price had owned 70% of 2,329,000, which had been worth 1,630,440. So before the share buyback that was done by Slice Company, Price's investment or the Price's ownership in Slice Company was worth 1,630,440. After the share buyback, it has decreased to 1,562,000. So the difference here now indicates gain or loss. Let's say so-called loss. So I'll put the loss in quotation marks. We're not really going to record it as a loss. Um, Instead, we would debit retained earnings. You want to debit retained earnings and credit the investment in Slice for the 67,729. Okay. And then if you were to calculate the investment account balance, it's just a matter of making sure that you adjust for the downstream equipment gain. Take the $10,500 out, you get the investment in Slice. So Feroz, these were all separate um, cases, separate scenarios. So it's not a continuation. If you did, yes, if you did have a balance in contributed surplus, then it is more correct to debit the contributed surplus first, exhaust that, and then go for retained earnings. No worries. So one quick look again. We looked at 4 scenarios: parent buying extra shares from the open market. Well, that results in an increase in the parent's percentage ownership along with a decrease in NCI's share. If the parent were to sell shares, then that results in an increase in the parent's ownership, a decrease in the parent's ownership and an increase in NCI's share. The total combined value, though, of the subsidiary does not change. It remains constant. What happens if the subsidiary were to issue shares or buy back shares? The value of the subsidiary undergoes a change. So there is not only a change in the percentage ownership of the parent as a result, but also a change in the subsidiary's total value. So this makes this scenario, the subsidiary issuing shares or buying back shares, a little different from the earlier one. Here we were just calculating, we calculated the adjusted net book value, and the rest of our math was based off of that number. Whereas in the case of the subsidiary issuing new shares or buying back shares, we had to calculate a revised amount for the subsidiary's book value after the additional share issuance or share buyback.